Today we are talking about Blade Urban Air Mobility, which is going public via a SPAC. The symbol for the SPAC is EXPC, which is from Experience Investment Corp, because finance types can't come up with creative names for SPACs apparently. The symbol currently is EXPC, but in the future, if the deal goes through in the first half of 2021, the stock ticker is going to be BLDE. So Blade stock, BLDE stock, currently EXPC stock, which is the SPAC or pile of cash looking for a deal. In this case, they found the deal. It's Blade. We'll get into Blade. What is Blade? What is Blade stock? Blade is supposed to be like an Uber, but for air travel, for helicopters or small jets. And it's particularly interesting because there's an angle around not only small helicopter travel and satisfying certain, sort of high-end niches. There's also this potential for exponential growth with electric vertical takeoff and landing vehicles in the future, which could dramatically open up the market. Management thinks that they can grow this company by something like 35x, so a huge multiple in just the next few years, which, slapping on, some sort of multiple could get like 900% upside at least in the years ahead. But that depends on them hitting management's expectations. I'm going to have, my cut of what I think they're going to do at the end of this video. So you're going to have to tune in for a second, to see, my take where it's low, high, and what management thinks. And this video goes out to Kate, who is an Unrivaled Investing Journey subscriber. About that, let me do a quick 10-second plug. And so you are watching Unrivaled Investing. This is a no-hype, mission-focused financial channel that is looking to find exceptional companies and unrivaled investments. If you enjoy trying to find potential multi-bagger stocks that can go up hundreds or thousands of percent, make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up. Please hit that thumbs up right now. And if you want to follow my personal journey to try to find potential multi-baggers, go to unrivaledinvesting.com, click on Journey. Now let's dig into Urban Air Mobility. Blade Urban Air Mobility, I should say. So what is Blade? As I mentioned, it's a very interesting business model. It's effectively an Uber, but for helicopters and the occasional jet. And you can see sort of, this is a high-level overview of their business model. If you can't see it, I'll sort of walk you through it. And I'll do some close-ups of some of these things shortly. But what they're trying to do is say, hey, look, we're going to aggregate demand, just like the way Uber aggregates demand for the app. You have this brand association of like, oh, I'm going to use the Blade brand. It's the app that consumers use. You aggregate users. You take care of the customer service. You make sure you have a good experience. They take care of the customer experience staff to make sure, hey, when you're going on a flight, does everything go smoothly? Do you get the top, from the time you take off to the time you land? Are you pleased? And the way the model works is it's supposed to be an asset-light business model where they are not investing in physical assets for the most part. We'll get into that in a little bit. But for the most part, it's about enabling helicopter operators, so the folks that do own the helicopters, to get more mileage or get greater utilization out of their vehicle. So these aircraft are branded by the Blade brand, but they're independent parties that are sort of verified. So you don't have that sort of App Store 5-star ranking aspect to it that you get with Uber, where you sort of kick out the bad drivers. But you do have a business model that's where it's Blade sort of triple checking to make sure they have the right operators, that they're flying by the right conditions, they keep their aircraft in tip-top shape. So this sort of splits it up where they are aggregating demand, so the helicopter operator doesn't have to worry about it. The helicopter operator doesn't have to worry about marketing or customer service or the technology coordinating, oh, what routes am I going to fly? But they do have to focus on the basics like training, the mechanics, where are they going to store the helicopter, and any sort of aircraft expense, like, hey, you're buying the aircraft, you're buying the helicopter, you own that cost. We're just paying you on a per hour basis, where we're only paying you if it's flying. And that payment, that fixed rate payment, should cover all the expenses for the operator. So let's go into this a little bit. And by the way, this is not a pie in the sky company. You see a lot of pie in the sky, SPACs. This is a real company. This had 37,000 passengers that they flew in 2019, and that's rapidly growing over time. You'll see that in a second. And cumulatively over the life of Blade, they've served something like 200,000 passengers. So this is a real company. So broadly, what are the economics, or at least the gross margin economics of the business? And the business, as you would expect, very similar to airlines in that you need to get to scale. You need to get utilization of the underlying vehicles. That said, you're not owning the vehicles, so it's a lot less of a hurdle for you. It's more of like the Uber aspect where you could potentially have much greater margins longer term. But how does this business work? Depends on getting the utilization of the helicopters. Generally, 6-seat capacity helicopter, where Blade enjoys reduced landing fees given significant and attributed volume. So the landing fees, the Blade has to pay fixed fees to the heliports and airports where they're landing. And this is a part where it's interesting, where if you say, hey, we're going to be using this heliport a lot more than these other operators, you can get, let's say, a volume-based discount, which is an advantage versus a small operator. So the small operators are like, man, your cost structure is going to be better than mine. I might as well work with you because you're going to get that better deal in terms of licensing out or the landing fees on that heliport. And you're going to be able to find me the customers that I would need to sort of run this helicopter business. They also have this flight cost aspect where it's a fixed hourly rate paid to Blade's operator, covers pilots, fuel, maintenance, insurance, hangar expenses. So that fixed rate on a per hour basis, that's supposed to cover everything for the operators. This is very similar to Uber, where it's like, hey, we're going to pay this amount. That's supposed to cover everything. And if this is a win-win, you're going to keep doing business with us. If it's a win-lose, you're inherently not going to do business with us. And so the fact that they've grown significantly over time, which you'll see in a few minutes, does suggest that they're creating this win-win value proposition that might even be triple win, where they win, the operators win, and the consumers win. We'll get into that in a second. The key point here is that they're profitable on the third seat. Once again, you need to get to scale. You need to get people using these helicopters. Maybe you start sort of having like an Uber pool sort of solution, except it's instead of Uber, it's Blade. Elimination of fuel margin charged by infrastructure owner creates pass-through fuel cost savings. So if they, if they coordinate an agreement where they're like, look, this is what we pay you as an operator of the helicopter, this should cover everything. If there's a charge from a given infrastructure, like this helipad says, hey, we're going to charge you for the fuel and landing, and we're going to fuel up your craft, that's something where that fuel charge is going to get passed on to the operator versus them having to pay for it. And they also make a key point here where ownership of key infrastructure would result in reduced costs of them landing fees and further landing fees in the future, i.e. if they buy the heliports outright, or they buy the spaces in the airport outright, they could have better margins in the future, which would give them further competitive advantage in the years ahead. We'll discuss that also in a minute. So what are their current revenue sources? So first, short distance flights covers like 75% of their revenue, at least it did in 2019, where short haul being 60 to 100 miles. Think Manhattan to the Hamptons. You think really successful banker, hedge fund manager, lawyer in Manhattan that is willing to splurge several $100s on a per person flight to Manhattan to the Hamptons, then they can do that. And you can see the cost is around $600 to $800 per seat, or $300 for monthly commuter pass. And that's that $295 for the monthly commuter pass, where you have to pay $965 up front for the monthly pass. And so, you can see how this could be compelling, of saying, well, wait a second, $295 with effectively $1,000 up front. If I'm going to use this a bunch, like go out every weekend, and I'm rolling in the dough, this could be pretty compelling. This is 75% of their business, this short haul flights on the East Coast. And it's sort of a question to me, and we'll get to this a little later, of how big this market could be. But this was the root of this company's founding, where the founder was like, wait a second, I did this trip before, back when I was an executive for Sony, and I was hosting some music talent, flying from Manhattan to the Hamptons. And I was like, holy smokes, this is the way to travel. Why isn't this going mainstream? And he realized the cost was like $3,000 per seat. So he's like, how can we change the structure here so that way it's more of an economic triple win? And I think you're starting to see it with getting greater utilization through an Uber-like aggregating app. So that's really the angle here. But you can see currently the business is around 75%, at least as of 2019. There was some disruption because of COVID. This Northeast short distance, 60 to 100 miles, was the vast majority of their business. And then you have MediMobility, which is the largest transporter of human organs in the Northeast United States. That's about 20% of their 2019 revenue, expected to grow with the rollout of electric vertical takeoff and landing vehicles. Management claims that their solution of helicopters actually reduces the time for costs and transport times for hospitals versus legacy competitors. I'm not really sure what the argument they're making there. Like, are they saying, hey, is this cheaper and more affordable than having a limousine or having, an ambulance take the organs from one place to another? I think that's the argument that they're making. And either way, this is around 20% of their 2019 revenues. That you're looking at here, which is this MediMobility aspect. They write jet here, which makes me wonder if they're using some jets for this, some small aircraft for the transportation of human organs in the Northeast. We'll find out, when they come out with a detailed proxy on this company. So then also their airport segment, I'm going through their different sources of revenue. The first is the short haul, next is MediMobility, next is airport. These next two are much smaller segments. Airport was less than 10% of revenue in 2019, but is now closer to zero, primarily because of COVID. As they paused the service, it was priced at a really great price of $195 per seat, or $95 with an annual pass. That strikes me as an incredibly interesting value proposition for consumers. Management expects this to grow to nearly 25% of their business within the next few years. And you can see here's the 2019, figure where it's teeny tiny, Blade Airport, this light blue, and in the future it's nearly 25, nearly a quarter of the business. And then next up, management talks about two other initiatives for growth, such as West Coast expansion, and that's what you see here in this darker blue West Coast -other, which they expect to also be about a quarter of their business, as well as international JVs or joint ventures. And the international JVs is actually really interesting, where, like, for example, in India, they're working with a joint venture with Hunch Ventures, which has deployed over 100 million in consumer-facing businesses in India, i.e. they're a small partner with Hunch. Hunch is the primary investor, and they created this Blade-like company using the technology Blade has already rolled out in the US for a venture that will roll out these types of Uber-like helicopter services in India. The JV structure includes royalty paid to Blade on revenues and profit share. Okay, so like this could be very high margin business because it's based on revenue. It's almost like a franchise fee. Blade owns a minority stake in Blade India with the opportunity to increase our ownership through additional investment. That's the reason why you're not seeing this international JV here, is because it's a minority stake, so it's not flowing to their revenue line. It would be reported in their equity interest. So they show two examples here of where it could be really valuable, saying from Mumbai to Shirdi. For all the Indian viewers, if you have a correct pronunciation, please let me know. Where they're saying religious pilgrimage route, Shirdi is visited by between 25,000 to 100,000 people each day, with the average wealthy Indian visiting 2 to 4 times per year. The flight time's 45 minutes versus 5 to 8 hour drive. So if anyone has local knowledge on if this is actually a relevant comparable, I'd love to hear it. Or if people take the train or what have you. Similarly, the Mumbai to Pune, where you're saying the flight time's 40 minutes versus 3 to 5 hours drive time. So once again, if anyone has local knowledge on that, feel free to leave a comment below. I'd be curious to see if this is a reasonable comparison, or is management sort of pulling this out of the air. So here it is. Management claims to have a #1 market share in New York City for helicopters, which is interesting. Sort of saying, hey, we are the #1 player if you want sort of this short haul around Manhattan, where you're zipping around between these different airports. Here's Manhattan, you fly to JFK, or you're flying over here, flying over there. And now let me ghost myself. So Here's why they might just have this leading market share, which is that it's due to these favorable economics in time, where you can see over here comparing Blade, this is Manhattan to JFK. Blade, they're saying, is 47 minutes than taking the train, 47 minutes faster than taking the subway or train, and it's nearly an hour and a half. It's nearly an hour to 2 hours faster than driving potentially, and they're including potential traffic delays over here. And then they do another example of looking at New York City to Philadelphia, where they're comparing Blade to various different trains and driving. And they also do this price comparison, sort of showing that, look, it's really in line. This is not, like an everyday cost. They're saying Uber Black and Limo Black car. So they're comparing themselves to a high-end service, which makes sense. You're flying a freaking helicopter, so it makes sense to do a comp to what would the consumer think. Like, is the consumer going to be choosing an Uber Black? These guys aren't going to be, riding a bicycle to get where they're going. So you're looking at this, and this price, range actually strikes me as interesting. So them saying, look, based on this annual $795 airport pass, the unlimited $95 seat flights, here it is $195 versus $250 for a limo, or $215. This includes surge pricing for an Uber Black. It's interesting. It's I suspect if you're looking to get around town, you might not really care, and you have the wealth to do it. You might not really care if it costs $110 versus $195. You really care that you're saving 2 hours, and or an hour to 2 hours, and that's really the big deal. Is if you have the means to spend it, this delta is small enough where it becomes worth it, and you're really starting to open up an interesting market. That's the part that's getting interesting about that. And that's part of the reason why management is posting these incredible looking projections. And you can see, what each of these segments are, like Blade Airport or the West Coast / other. And so, here it is. You're looking at 25 million in revenue in 2020, and they're penciling out 52 million in 2021. So like 100% growth in 2021, and then continued very fast growth in the years ahead, doubling from 2022 to 2023, doubling again from 2023 to 2024, and then going by 50%, 24 to 25. So very fast growth in the years ahead. And what's interesting is, well, they effectively remain to be break even. Like negative 12 million in EBITDA isn't that huge relative to 50 million in revenue. It's not like they're just burning tons of cash. So this is a lot more profitable than you'd think. And so here it is. You're looking out a few years, and they're penciling out really huge profit margins. They're penciling out nearly 40% EBITDA margins. 326 divided by 875. That's nearly 40% EBITDA margins within the next few years, which is interesting. It's an interesting, it's an input that we're going to want to include when we think about the valuation. They put this dotted line here to sort of note the difference of when they start assuming this electric vertical takeoff and landing starts impacting the market, because they have this big bull case on electric helicopters, which we'll get into in a second. But the question is 50 million in revenue, feasible when you're looking at 25 million this year? And what's interesting is, let's look at their historicals, and I got to give them a lot of credit here. I've looked at many SPACs, and you can look at my channel's history, or I'll post a link of all my videos that I've covered, and I've covered many SPACs on this channel, most of which, if not, I don't think I've seen any go back to 2014, at least very few. And so it's really nice to actually see what historical revenues are for this company, and to see how they've compounded over time. And here's the passenger growth, growing at a really good clip, 24,000 passengers to 37,000 passengers from 2018 to 2019. And you can see they're growing at 30 to 40% a year for several years, from 2015, 2016 onward. It's a good clip, 30, 40% a year. So I'm impressed with this. It's interesting to say that they were budgeting 50 million pre-COVID, when they were doing 33 million in 2019. Seems like it's in the realm of possibilities, definitely in a pre-COVID world. So for them to say, hey, we're aiming for 52 million, that's like, yes, I think this is very feasible in a post-COVID world. And maybe even before COVID's done, we start seeing numbers that get you there. And that's this, where they're like, look, our year-to-date figures as of March 14th, before COVID really started crushing our numbers, we were up 61% on revenue. That means they are crushing it. They before COVID, March 14th, passengers were up 127%. So their new initiatives on airport, I think, was really getting traction on saying that really low price point, like 100, $200 for per flight. You have to pay this monthly fee, but you can pay as many as you want for the short haul and airport. That was really resonating with the market. I mean, this is fantastic growth. That is an acceleration of where they were. But then since then, year to date through October, it's been hammered down 31%. And that's because people are like, well, wait a second, do I really want to get in a helicopter with potentially someone else? Is this worth it for me? Do I really want to go? Or am I just going to, fly out of the city once and I'm not going to and from Manhattan? So this is tricky. But then you look at revenue in October and it's up 51%. So maybe you start seeing a recovery, in October that started playing out. This data definitely increases the odds that they could hit 50 million in revenue sometime in the future. I don't know if it's 2021, 2022. It definitely depends on COVID, but it's super interesting to see this growth. I mean, this means their value proposition is resonating with consumers and they're tapping into real market potential. 100% plus consumer growth means real market potential in my opinion, like something that clearly resonates with users. And here's where it gets even more interesting, where they're like, look, if you're willing to squint, you can see even greater potential 2025 and later, where you're looking at this eVTOL or electric vertical takeoff and landing aircraft. The reason why this is interesting, or at least the way management frames it, is that these vehicles are quiet and that they're lower cost of manufacture and operation. And so if they're quiet, which honestly I'm a little skeptical of. I've seen plenty of electric small drones flying around. They're noisy as heck. It sounds like a loud swarm of bees flying around whenever I see them. But management's saying, look, they're low cost, low noise footprints, zero emissions. The reason why this could supercharge their business is because then there could be more mobility platforms that can get built out where people approve, cities approve, having these flying around them. Now, Elon Musk has made the point, and this is why he has sort of that tunneling boring company, is like, do people really want all these blades flying all overhead? Like, do you really want to see a 10x increase in all these crazy, like helicopters flying around, these electric helicopters? I'm sort of skeptical of that. Management's talking about limited moving parts. I see this and I'm thinking, like, there's so many more blades on this. This sort of freaks me out if that were over my head. That's my personal take, but from management's perspective, it's A, quiet, so you're going to have it, you can have more of them. B, lower cost of operation, which means you can lower the price, and therefore it's sort of like Uber going from limo to a much cheaper affordable option like Uber Pool, and then it's you dramatically open your market, you dramatically accelerate your growth, and that's why they're penciling out growth acceleration. When you're looking at, oh man, here's this 50% growth acceleration, when you start assuming this electric vertical takeoff and landing. I don't know why it's eVTOL versus e-helicopter, because helicopters are presumably vertical takeoff and landing, but nevertheless. So they're making the point, like, look, don't mark this as doubtful. Like, there's billions of dollars being invested in the electric vertical takeoff and landing aircraft over the last 5 years. You can see all these different players, one of which is Airbus. Airbus is an investor in Blade, which is interesting. They invested in Blade's Series B round. And so, like, there's so many different players with all these crazy blades. Look at all those blades on this guy. That, like, they're saying this is going to happen in the next decade, which is exciting to think that if they could get that price point down even further, so that way you could take this Blade Uber-like experience for $50 and fly around, because now that price point's that much better. I think you really do get mainstream adoption in that scenario. So this is a super interesting angle, and my concern is that it's management's attempt to get a loftier valuation, because they're sort of playing into, like, hey, this is actually also an EV play, or an electric vehicle play. Like, And in their presentation, they call out like Nikola and Tesla. First of all, I don't know why they called out Nikola. Nikola is being associated with a fraud right now. Tesla, I can understand, but either way, this is a reach. Like none of their vehicles currently, none of their aircraft are electric. This is sort of like pie in the sky. If you squint real hard, you can see how this impacts their business in the years ahead, closer to the end of this next decade. So I think this is management's attempt to get a loftier valuation, in all honesty. So what are the terms of the deal? It's actually a very straightforward deal. You get this $275 million in the Experience Investment Corp, or EXPC stock, the cash that's currently there, plus another $125 million in the pipe. So that's $400 million that goes to the company, of which $375 million goes to the balance sheet. That's what I like to see, shoring up the balance sheet. Then $25 million to expenses, which seems about right. What is high on this is that the SPAC sponsor is getting 8.5% or 8.4% of the company just for doing the deal. That's a really high rate, which makes me wonder if Blade was desperate to get a deal done, because normally I'm seeing rates from like 3 to 6. So to see the sponsor get 8+%, that or Blade's bringing something, the SPAC sponsor, Experience is bringing something interesting to the table. They have talked about how they have relationships and they have other portfolio companies that can act as effectively like maintenance. They have a maintenance company that has like 17 different sites that can provide maintenance for the vehicle fleet. But that turns into a conflict of interest, because you don't want one portfolio company necessarily supporting the other, because then it's like, well, what profit margins, what sort of contracts do you sign between these portfolio companies? So I look at this and I'm starting to like, good to see the cash going on the balance sheet. Don't like the sponsors getting so much, but that's what makes the deal go through, I guess. So what's management going to be investing this $375 million in cash in? Like, why do they need it if they're going to effectively be close to break even over the next few years? And the answer is that they have a whole slew of projects that they're looking to invest in. And they talk about actionable acquisitions, i.e. things that they've currently queued up. Like they think they can do it very soon. So they're looking to acquire heliports and logistic bases in the Northeast where Blade has current operations. The reason why that's interesting is they're saying, look, that would have immediate cash synergies. So i.e. lower costs for them, landing fees, fuel savings, and repositioning costs. Then also, starting to get the infrastructure, maybe it's leases, maybe it's buying it outright in San Francisco or Los Angeles. This would help them expand their routes. Then also marketing different routes. So you could see like $114 million for core assets, $43 million for West Coast infrastructure, $50 million for route expansion. Saying, look, when you launch a route, it's going to be unprofitable, so you need to set some money aside. Then $75 million for opportunistic acquisitions. They're saying, look, there's in the presentation and elsewhere, they're saying, look, several companies have been impacted by COVID. This could be great if we have cash on the balance sheet. We can actually sort of sweep up some of the other players. They're saying hundreds of thousands of short distance flyers and remove competitors. This is the part that sort of bothers me a little bit, which is that you do have a lot of competitors out there. I don't know for sure that this app is going to aggregate all that demand. It potentially does over time. Like, look, pre-COVID, they were growing over 100% on a passenger basis, which would suggest they're taking market share. There's no way, or I'd be very surprised if the market for helicopters is growing over 100%. Very doubtful. And so in which case, they're taking market share from other competitors, which are probably these one-off operators. So maybe they sort of force these other operators to go out of business, or at least create some sort of contract where they become exclusive operators on their platform. And then another $30 million for general corporate purposes. So, it's interesting how they're sort of laying this out, saying that they're going to spend at least $100 million for actionable acquisitions of heliports and logistics bases. That sort of pulls away from that thesis that they're purely an asset-light company where it's, they don't own the assets of the helicopters. Well, it's like, well, wait a second, you're going to be owning the heliports, because that'll give you a competitive advantage of, hey, location is everything here, and you're going to lower your fees long-term of landing fees as you scale up this business. And so that those I'm not criticizing these investments. They definitely make sense if this business scales. It's just making the argument this is an asset-like company doesn't really fly if you're going to start making those investments. So what are my thoughts on the valuation as I look at this? So, it's currently a little under $11 a share. This is EXPC stock. which is going to be merging with Blade. So it's the EXPC SPAC, around 913 million implied market cap. Now keep in mind, as I lay this out, I did not include the 400 million in cash on the balance sheet, largely because the way management's spelling it out here makes me think that they're going to spend most of it on these various different initiatives. So I don't think it's really appropriate to back it out when I'm thinking about the valuation. That said, that cash, 375 million, that's over 1/3 of the balance sheet of its market cap is in cash. So that is interesting. Here it is. I do a low to high scenario. And this sheet, you can play around with yourself. That's part of my value proposition to you. You can click on it, you download the sheet, and then you start playing around with the assumptions. And look, could it go higher or lower than what I pencil out here? Of course, this is just my logical framework for how I think about this setup. And so, as I look at this, penciling out somewhere between 45 and 50 million, this is my low to high. Management thinks it's closer to 52 million in 2021. You can see what the implied growth rate is off of their 2020 guidance. What are the long-term margins for this business? Once again, penciling out this asset-light business that's sort of aggregating demand, primarily this super app for getting people from one place to another via helicopters. I've seen other apps like Uber penciling out 30% plus EBITDA margins, so penciling out 25 to 35% strikes me as quite possible for this business. Management themselves are penciling out 30 to 40%. So here it is. I give management 40% credit in management case, which is the above and beyond, expectation for what they look like. Then I do, what's this growth look like over the next 5 years? And that is going to be the key element what we're looking at here. And I'm saying 25 to 35%. I'm putting out a range. That's how I like to think about investments. Let's do a range on this. And look, their growth rate over the pre-COVID was 30 to 40% a year. So, annualized. So as I look at this, I'm thinking 25 to 35% annualized over the next 5 years. That seems like a reasonable ballpark. Whereas management's like, yes, we're going to do closer to 76%, which gets to around 875 million in revenue by 2026. That's based on management's guidance of 875 million in revenue by 2026. That strikes me as like this massive acceleration. In some of those future periods, they're talking about doubling year over year in their business. That's pretty lofty. So, based on my low and high, I'm penciling out, I assume like a 20 times multiple on the low side, 35 times multiple on the high side. A lot of this depends on, how much of the margins are they actually executing on 5 years from now, and what are the growth prospects 5 years from now. That determines what the multiple would be. I did a whole video on this exclusively for Journey subscribers about how to think about valuation. So if you're interested, you can check that out on how I'm sort of thinking about these multiples. So 20 to 35 times for the low to high, that gets to, down 40% plus versus upside of 100% plus. But then if you take management's case, and keep in mind, this is that 35x, 875 divided by 25, that's 35 times, what they're currently at, 25 million versus 875 million. So that's a huge jump. Once again, applying 35 times, the multiple could be even higher. If they're actually delivering on this level of growth, the multiple could be higher. And they're this level of profitability. But if they deliver on that, then you're talking about nearly a 10-bagger. You're looking at 900% upside, which is interesting. Saying 900% upside over 5 years, if you start seeing these growth, if you see close to what management's penciling out. Now, a lot of this depends on COVID. Like, do you start seeing this big resumption in helicopter demand, especially with their new initiatives around the airport and monthly rates? Like, this is the amount it costs per flight as long as you pay this monthly rate. So management clearly thinks there's a lot more upside, than upside potential than what I'm sort of showing here in the low and high scenarios. For those that are looking to speculate in this situation, I could definitely appreciate that element. Like, you're looking at a SPAC where there's $10 in cash effectively on the downside, so you're like, hey, there's 10% downside, and I could see speculators get excited about this and start pumping this thing up, or it goes up, a lot. And that's the environment we're in right now, where there's speculators, pumping crazy things up. So for a company that's a real company like this, could you see speculative juices take over and people start to think this management, case scenario plays out? Absolutely. So for those looking to speculate on these sort of scenarios, I can definitely appreciate the risk reward and what they're doing. That said, it's a different question of, am I personally going to invest in it, or do I think I've found things with better risk reward? And personally, I do think I've found some things with better risk reward. Earlier this month, I called out, and I called out something I personally invested in, a stock that I started off investing 3.5%. This is an update. I'm actually increasing it to 4% of stock, where I think there's nearly 500% upside with even more potential. And I like the upside downside potential more than I like this. I think it's higher probability that it happens. And so Journey subscribers can see that. And what do I mean? You have to go to unrivaledinvesting.com, click on Journey to see what I'm doing. If you're interested, what am I buying, what am I selling, what am I holding? But there's a lot of exclusive content. There's exclusive content on certain companies. I usually do a YouTube video and then I post some exclusive content. I also have an educational series. I mentioned one of which is how to value stocks. The other is how to think about long-term margins. The other is optimal betting. And then also my goal is to try to find one potential multi-bagger at least each month that I'm calling out saying, hey, I think this company long-term has multi-bagger potential. And finding just one potential multi-bagger can change your life journey. So if you're interested in following my journey each month, this is a long-term journey. This is not a day trade. This is months and years that I'm, plodding along each year trying to find these companies that I can partner with and sit tight on and watch them compound. So if that's something that you're interested in, trying to find these multi-baggers that can change your life journey, and you want to follow my journey, you go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video, learning about Blade Urban Mobility, it's currently EXPC stock, or the EXPC SPAC, Experience SPAC, because finance folks can't come up with more creative names. Please make a point of subscribing. If you've already subscribed, I really do appreciate seeing those thumbs up. I like to know that you like these videos. Thank you. And thank you so much for watching.